Welcome back to Click Capital, your go-to channel for market analysis and all the latest data and charts, where I share my insights from 20 years of trading for myself and clients. And if you're watching the show yesterday, you knew I came in today 100% net short. I had a great day. I hope you did as well. Stay towards the end. I'll tell you how I'm positioned going forward into next week, into the big Fed decision. And I'll also show you a bit about my hidden divergence indicator, which I've just made available to the public. And I'll show you what it's telling on all the key markets and where we could go to next. So let's just jump over to the heat map like we always do. And so today we're mostly red, apart from Microsoft, Google, mega cap tech being supported once again. We were mostly red across the board, with financials coming off hard again, and Meta the exception, and mega cap tech coming off 4.5%. Industrials got hit a little bit as well, and so did REITs. Over to economic data, we did see that Michigan Consumer Sentiment Survey come in a lot weaker than expected. Consensus was 67, came at 63. And 85% of these participants were surveyed after the collapse of Silicon Valley Bank. So I can imagine that would have been even worse, knowing that. Industrial production was off a bit worse than expected as well. So that just shows signs of a slowing economy and can add to supply restrictions and inflation as well. Fear and greed, pretty much flat, still an extreme fear. Down here at 25, even though price action in the main indices doesn't match this, we've actually got NASDAQ breaking out and we're in extreme fear. And that's because this indicator looks under the hood at a bunch of different things that's going on. So the markets are still fragile, especially in credit markets as well. Over to most active options today. So quad witching today was a big day, and we did see big volumes in the usual suspects: Tesla, Nvidia, Apple, Microsoft. But what was interesting today was the percentage that were calls. So 60% calls on Tesla, 52% Nvidia, 53 Apple, 60 Microsoft, 58 AMD, 61 Amazon. So overall, there's a lot of people loading up on calls today, and we can see that in the put call ratios, which I'll get to a bit. Dark pool buyers are kind of just sitting down here around 45%, which is kind of a neutral level. They had pulled back, but seem to be holding on here, and now we've got gamma exposure in positive levels as well, so that'll help dampen any volatility instead of adding to it. Corporate insiders, the pullback and selling has picked up a little bit. We did see insiders buy the dip a little bit earlier in the week, but they appear to have just come off a bit, but still elevated. And there's still a bit of selling. So it appears that insiders are active here, buying and selling. Fed fund futures probability. So that came down off a bit today. Big moves here in the bond market every day. We are whipping back and forth here. Still 63% chance of a hike. I think Jay will hike. We just saw ECB go 50 basis points yesterday. They didn't seem to mind what's going on with Credit Suisse and, fears of contagion. They're focused on inflation. I think the Fed will do the same. With markets, if everything's kind of settles down a bit, the next couple of days are going to help determine this decision going into Wednesday's meeting. But as it stands, I think they will go 25 basis point, but with really cautionary language from Jay, so he'll try and calm things down and support the system. They're already pumping liquidity, offering a lot of bank loans. So with risk markets rallying, I think that's good excuse for him to go 25 basis points. And we can see the balance sheet is increased by $300 billion from the Fed. Now, this isn't traditional quantitative easing where they buy treasuries and mortgage-backed securities. This is loans to banks, and through their new bank term funding program, the bank's been borrowing off the Fed. So nonetheless, the balance sheet's gone up. There's more liquidity sloshing around in the system. And famous economist Milton Friedman, I'm sure a lot of you have heard, he passed away in 2006, and he won a Nobel Prize, and he'd done a lot of good work towards free market capitalism, and he was just a great holistic thinker. And he's got a great quote here, inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first, the bad effects only come later. And it's true. It's just like money printing is just like alcohol. You can have a little fun with it, but if you overdo it, you've got to pay a price. There's no free lunch. So I think a lot of people are realizing we're coming to too much money printing, so that could have really bad long-term consequences for us all. And they say in trading and markets, everything's a signal, and we've just got another signal here from Jim Cramer: short this NASDAQ and invite me to your funeral. So this guy is chronically wrong. The stats prove it. He's worse than random. This doesn't mean the NASDAQ's going to crash, but he has a record of being quite wrong. So we'll check back on that one in a few months. And as they say, when the tide goes out, you can see who's swimming naked. When you have these huge moves in markets, someone's bound to have blown up, and we're starting to see that. Macro hedge fund here plunged more than 25%, and he wiped out years of gains, and so he's closing down. This one, a long time trader, Adam Levinson. So there's one of, I'm sure, more victims to come. And Bill Ackman is said Bank of America is going to buy Signature. I'm not sure where he got that information from. I'd be surprised if this happens, because if it does happen, he will look to have got some sort of insider information here. But that would be surprising if Bank of America wanted to get involved in this. But who knows? Maybe it's possible. We'll see what happens. Okay, so back over to the charts. So today I've added on my hidden divergence indicator, and I wasn't sure that I was going to release this to the public or not, but I have done so. It is available, and I'll show you at the end of this video how you can get it. But basically, it's different from all the traditional divergence indicators like RSI, CCI, MACD. I don't want to give too much away about how it's calculated. I've already had some other competitors try and copy some of my indicators, so I'm not going to give too much away on it, other to say that I've been using it for a long time, and it can show divergences where the other ones don't. And also you can use it for absolute readings too. So when it's negative, that can be considered bearish, and when it's positive, that can be considered bullish. So we've got two divergences playing out here in SPX. We've got this big one from here. So we've got price, you could say, is flat from here to here. And then we've got this bearish divergence. But we've also got a smaller one where we've got price being down here and up here. So that's mixed signals. And with our range strength at green 9.47, the market is trading kind of really fat. So we'll just get rid of all those trend lines. And we can see on global net liquidity. So with central banks pumping liquidity back in the system, we've actually got the net liquidity model at 39.68 on SPX, which is actually above where we are now. So this liquidity is going to support the market with what's happening. So even though we've still got a lot of headline risk and really dark storm clouds in the US banking system and a lot of fear out there, there's liquidity supporting this. And we've just constantly see every time we dip, we get bought up. There's just buy the dips out there everywhere. But we'll come back to that at the end of the video and let you know how I'm positioned in my personal swing trading portfolio going forward. Let's just keep going through the markets like we always do. So the S&P was off 1.5%. Equal weight was off a little bit more, so that's starting to slow down and close the gap. But we've still got mega cap tech made new highs today on the Qs, and they're breaking out, trading really strong. And we had mid caps and small caps still trading really weak down here. Over to internationals, Canada, England trading really weak down its low. Same with Germany. Nikkei's had a bit of a bounce. Australia's trading really low, and China looks to have broken out lower as well. VIX, we got a bit of a pop up in the VIX today. Still a lot of fear out there in the banking sector and what it's going to do. I'm going to get into that in a bit. But we've got the VIX at 25, and the back end actually picked up a bit more, 3-month at 27. So this market's going to stay volatile for some time. We've had volatility asleep at the wheel for some time now, even though we've got all these geopolitical tensions backdrop. I mean, Russia just shot down an American drone this week. The market went up, the Nasdaq's gone up, but look at VIX. Volatility is recognizing what's going on out there, and especially at the back. Looks to be repricing higher for longer. And volatility is really elevated as well. So things are moving all over the place. And bond market volatility rallied back up today, 180 on the MOVE index. And not many people buying puts out there. as we saw, there's a lot of people buying calls out there. So a lot of mixed signals, strange times, a lot of things happening right now. And we can see the skew, put premium over, we'll put that on a 3-day chart so we can see that. That's gone up as well. Price of insurance, breadth, amount of stocks above that 20-day average, 21%. So that's kind of just really shallow. Stocks above their 50-day, 19%. So we've seen a move up in these markets, but it's the mega cap tech doing that, holding that. If so, looking under the hood at all stocks, breadth, things are really breaking apart. It's just those mega cap tech that make up 30% of the S&P 500, really holding things up. And you can see here in the amount of stocks above the 200-day average, 37%, and doesn't look to have put in a low yet as well. New stocks breaking out to new highs, really low as well. So there's more stocks breaking out to lows. Over the spreads, we're just tracking sideways on the overall cyclical versus defensive. Equal weight SP versus normal SP, actually new low today, really oversold here. Doesn't look to be bottoming just yet. High beta versus low volatility is sitting there. And look at this in growth versus value. And this doesn't look to be diverging either. We are just, breaking out. And we've been watching this ever since we broke out here. And same with Qs versus SP. Look at that move in the past week. And no divergence either. This is, with the banking failure, obviously there's been a lot of money move out of financials, and where's that money gone? It's gone into tech with the lower rates as well, because tech loves lower rates. So huge rotation into growth and tech. This thing's got a lot of steam, a lot of legs, and that's why we're not short tech at all. I'm not short tech myself or for my clients. I've actually got a little bit of long tech for myself and clients at the moment. So long term, I'm not sure on tech, but right now, this is a short-term steam train I don't want to get in front of. Smalls, absolutely slammed down, new lows today. Here's the Russell versus the S&P spread chart. And we're not diverging yet either on this. So this doesn't look to have found a bottom, even though we're really oversold here. So things are not over yet. Yield curve at minus 0.41 and climbing. And high yield versus treasuries, still under a lot of stress here in the market with credit spreads. And the 2-year, another big move. And with this volatility brings big mean reversion. You look at this big down day, up, down, up, down. 384. I think it's possible. Looked like we've got support here at 340 on the 10-year. It's possible the market could be underestimating the Fed's willingness to go ahead. Like we saw ECB go ahead with a 50 basis point hike. Maybe the Fed, they just come out and a little bit surprisingly hawkish and say, we've got things under control with banking. This is just a one-off. We still need to tackle inflation, and this could we could shoot back up here quite quickly. But regardless, if he paused, I can see it coming off more, but it's hard to see the 2-year getting down to 350 with inflation still around and unemployment still low. It hasn't ticked up yet. Regardless, we're going to have big moves in bond market for months to come yet. So this thing has opened up a can of worms, and that's not going away anytime soon. September Fed Fund futures 415 and December at 387. So the market's pricing in that they think the Fed funds rate is going to be at 387 by Christmas. So they're pricing in that we're going to be doing a bunch of cuts and things are going to get worse. So let's see on that. If they are right, then TLT should be a great investment here. Looking out at the monthly chart, we're diverging big time, and if rates do come off low, we should see TLT retrace back here up until this middle ground at least, and it's kind of a bit of a hedge on more instability in that flight to safety out of deposits, finance, and energy stocks into treasuries, gold, and Bitcoin. So we'll be keeping an eye on TLT. A lot of big volume coming into that. But even with lower rates, high yield can't rally. Putting in a little divergence here and a bit of buy the dip action here on these green candles with volume. But I'm imagining this could just choke around here for a bit while there's risk in the market for the for the most riskiest issuers, but we've got that low rates here as well, so that should help support bond prices. And with those low rates, dollar has come off, and we're not diverging here, and we're below the 50 bar VWAP. So dollar has gone from looking bullish to now we could be continuing this bear trend. If we go out on a weekly chart, yeah, things look to be, this could be a big one wave, two wave, and we could be starting a third wave down on the dollar. And euro's been supported, and dollar's come off, especially against the yen. And look at Bitcoin. If you've been watching this channel, you know I've been eyeing this off and thinking this could break out here, and we could start going even much further here. With the run on bank deposits out of regionals, the appeal of Bitcoin, and having, if you've got cold storage, then you don't have third-party risk. You don't have credit risk and the liquid global market. So, and fear of instability in the financial system, and government-backed banks and all that makes for a strong bullish case for Bitcoin and Ethereum. So we're seeing some big moves come up that off these divergences as well. Commodity complex sitting down here and trading pretty weak now. So even a weaker dollar can't help the commodities overall. Dr. Copper sitting down there below his 50 bar VWAP as well. Doesn't look like it's bottoming. But the exception is gold. Look at this move in gold. You've been watching my channel. You knew I actually got long gold here on this day when we broke out above here, but I exited out here. I have had some gold positions in my client portfolio and added some more today. So I'm really bullish gold, short, medium, and long term. So we've got high inflation now. The possibility of rates coming off. Well, the interest rate market has come off, but with the Fed fund futures pricing in the possibility of a pause, and we're starting to look at a pivot. So this is all bullish stuff for gold. And with the run on bank deposits, when you hold physical gold, you don't have third party risk, and you can sell that shiny rock anywhere in the world. And so we're up after market as well. So we are bullish gold here, and I've got it long in my client portfolios as well. Silver, much the same, but gold's better in this case. Oil coming off. So we're seeing oil inventories rise, and with forecast weaker economic growth, that affects oil demand. So we're selling off here after breaking through these support lines. So that's a pretty negative move for oil. And over to stock sectors. So everything was red today except gold miners. And with gold miners, that's like a high beta play on gold. You get about 2-to-1 on versus the underlying. So gold miners are about twice the amount of volatility as gold itself. So that gives you a much higher beta play on gold. And overall, pretty bearish today, except for tech. Look at the tech fund, basically flat. Retail was off 2.2%, and financials still, look at this, XLF trading down the low, and regionals as well. And doesn't look like we're putting in a strong bottom just yet. So this looks like it is not over, and we're not out of the woods yet. Real estate turning down. Home builders seem to be holding on there miraculously. Defensive stocks just holding a bit, and healthcare up a little bit. Staples holding, and utilities looking strong, still holding above the 50 bar VWAP. So it's been a little bit of a hiding spot throughout this in utilities, because the yield on them is now a little bit more appealing. That rates have come down. BlackRock, even though we've been trading really weak on BlackRock, we saw this hammer formation on volume. So it was a bit of a dip buy here, and we have got a pretty big divergence building on BlackRock. JP Morgan, not so much. Just sold off to new lows today on volume. So it did look like it was trying to put in a bottom on this volume and these candlesticks here, but we've just hit a new low today, so that's not good on the banks. Apple's trading up on this divergence. I've got a feeling Apple's going to break out through this resistance. We keep coming up to it, and the more we come up to it, the weaker it gets. So it's been there for quite some time. This 150s, high 150s. The way things stand, it looks like Apple could break out here. And Microsoft as well broke out today. Higher highs, higher lows. So money is rushing into mega cap tech. Amazon holding there. Google rallying up as well. But Meta did pull back a bit, and we do have a bearish divergence on Meta. So things might be a little stretched up here on Meta. AMD got up higher again, and Nvidia. So let's talk about Nvidia for a little bit. Higher highs, higher lows. We got out of this as a short, and there's a lot going on here. Believe it or not, Morgan Stanley just came out and upgraded them to overweight. So, like a typical analyst always did. Did they upgrade it on the dip down here at 140? No, they wait to 250. So they wait till price, doubles in a little over a few months, and then they upgrade it because they constantly just run with the herd. Their analysts base their recommendations based on career risk more than anything else. But there's a lot of people. It's kind of become such an obvious short when you've got trading at a PE of 146. Sales and earnings actually have been trending down the last couple of quarters, and we've got a huge price to sales ratio. It did 26 billion in revenue. We're on a market cap of 635 billion, but it's got a lot of momentum with this AI hype thing, and there's just a lot of people calling for it to be short. So I think it's so obvious. So this thing could rip easily higher, up to 300 if we look on a monthly chart. And if it does, we're going to take another stab at a short, maybe up in 298, around the high 290s, but might not quite reach 300. A lot of shorts get in front of it before then. And of course, we'll have a stop because we may even come up and test towards 350 on its highs. But it's got a super crazy valuation. It's technically overbought. There's a lot of longs stuck in it that'll get flushed out eventually. But there's a lot of people calling for a short as well. So we may just trek along sideways here. But if we were to go up on a crazy run, once we hit some sort of topping formation, ideally around the high 290s, we were going to get short on this thing again because there's just even more downside to play with from there. Netflix came off 2%, and Tesla. So I actually took a short in Tesla today. We've got this huge negative divergence. If we look from earnings day, we're up from there. But on our hidden divergence indicator, we've actually done a big positive to negative and negative 10, which is a big bearish reading. So that's a big divergence, and I always trade in the direction of our divergence indicator. But we're below the 50 bar VWAP now, and it kind of looks like we've done a bit of a pullback here. So of course I have a stop above the 50 bar VWAP, but I'm looking for us to come down and test that earnings day low, and probably look to get out around there unless we slice through it. But for now, I'm bearish on Tesla. Over to meme stocks. Coinbase had a great day on volume with Bitcoin breaking out. So the market doesn't seem to mind getting into that with the equity risk, and it's got a bit of a tailwind there with Bitcoin. So, and they're looking to go overseas with an overseas exchange if the regulators in the US clamp down on them too much. Rest of the meme stocks, not a whole lot, mostly just sold off. Active today, FedEx. Earnings came in a lot better than expected. We came in at $3.41 a share versus the estimate of $2.71, even though revenue was off a little bit. So the market seemed to like that, but sold those high prices. And over the banks today, Credit Suisse, so even though it's got a backstop by the Swiss National Bank, central bank injecting liquidity, offering it a $50 billion loan, sold off 6.9% today. And there's a lot of banks, other banks don't want to deal with it, don't want to trade with it. So I think this thing's dead. Zombie at a best. It's on its way out. Another interesting move is look at First Republic Bank. So all the big guys, the top dozen banks got together to deposit $30 billion into their competitor to help keep the system afloat. You think they would send shares rocking back up to $80, short squeeze, this thing's going to live, it's completely backstopped, it's not going under, there's no risk for equity holders. It came off 32% today, and we're down 15% after hours as I speak right now. So that's a worrying signal. $30 billion backstop can't stop the equity from getting completely plowed. what if this happens to other banks? They're not going to be able to inject 30 billion into every other regional out there that needs it. And if this what happens after they get injected, this thing's looking like it's going to be dead soon somehow anyway, or turned into a zombie. So that's a worrying signal. We could see a lot more happen. They're really trying to get ahead of it really quickly, but this thing's moving fast, and it could be setting up a bit of a chain of dominoes here. So something to look at. And all banks came off hard today. There's Bank of America, Citi, and Wells, new lows today as well. And all the other regionals still getting clobbered. So this thing is, like I said, it's too dicey. I'm not trading the regionals for myself or clients. I'm sure some of them, like Schwab, might turn out to be. We've got a bit of divergence on Schwab here. Seems to be the only one. The CEO bought 50,000 shares as well, putting his money where his mouth is. Good to see. So names like Schwab should come out of this alive and may turn out to be really good investments down here in the 50s. But this could be a mess that goes on for months, and some of these other smaller regional ones still may blow up, at least for equity holders. So interesting times for sure. Okay, so that's a bird's eye view at all the major market categories. Overall, what are we thinking on SPX? So with this liquidity pump coming in, the Fed pumping in 300 billion into the system, they will backstop it. It's just such a big bid for markets, and there's just still a lot of money sloshing out there that needs to find a home. And we can see the market's trading thick with this range strength, and we've actually got a bit of divergence forming here as well. But there's still a lot of headline risk. We're still under our 50-bar VWAP. We still have kind of a downtrend, except for the NASDAQ, which is technical uptrend. So just mixed signals all over the place. And I came in today 100% net short and took profits on my shorts. And I've actually gotten some longs. So I'm long some gold, I'm long some tech, and I'm long a few other defensive names, and kind of just flattened out my portfolio a bit, but I'm still 20% net short heading into next week. So can't get net long here, but I don't want to be net short into this liquidity pump and divergence, and there's just endless amount of bids in this market every time we drop. So something really bad will have to happen for it to open up. And I imagine we'll just trade a bit choppy into the Fed decision on Wednesday, and it'll be really interesting to see. I think this will be one of the most nail-biting decisions the markets have waited for on the Fed on Wednesday, and we could move big after that. It's kind of bad either way. If they pause, that sends a bad signal to the markets that they're really worried about stability over inflation, and that generally is when the markets sell off, is when the Fed pivots and pauses because the economy is contracting, or at least the Fed sees data to say that. If they raise, then it adds more pressure to the banking system and their balance sheets and mark-to-market losses. So either way, I think it's kind of a bad. But once again, there's liquidity coming in. It's been backstopped. There's bids out there. We'll see what happens. Either way, I like gold. Out of all this mess that's going on, I can tell you right now, the cleanest price action is in gold. Look at that volume, and we just broke out to new highs. And so we are ripping on gold here. And that's not a divergence either. That's big bullish price action, and in all the gold miners as well. So, that looks like a hiding spot to be with gold. High inflation, now financial instability, flight on deposits, third-party risks, possibility of rates coming down. This is all bullish stuff for gold. Now we've got the price action to back that up. So the fundamentals and technicals are there for gold. So apart from that, I'm just pretty much neutral on the market. I've actually got a bit of long tech and just short some high beta consumer retail names, and I've actually short a regional bank as well. And before I go, I just wanted to show you our latest indicator, the hidden divergences, for those of you who are interested in testing it out and trialing it. Just come over to our website, clickcapital.io, come over to the indicators page, and we've got 13 indicators on TradingView, custom indicators. They've taken us years and thousands of lines of code to make, and they're unlike anything else you'll ever see. Some of them have got fundamental data in them, things like breadth, VIX term structure, seasonality, and all you need is a free TradingView account. And you just come here and you can put your email, your TradingView username, and check out with PayPal, and you can get each of our indicators. We offer a 7-day money-back guarantee if you change your mind. And we have 13 different indicators for sale, and if you want, you can get them all, save $200 just for one-time payment of $297 with PayPal, lifetime access, no ongoing costs, and you'll get access to them all straight away, and you'll see them under your indicators page under the invite only section. You can add them onto any chart you want. So hidden divergence, this is the one we've just been using today, and I'm going to keep on the charts going forward. Just $59 one-time fee. Just enter your email, your TradingView username, check out with PayPal, and give us an hour or two, and we'll give your account access to hidden divergence. And I use this indicator more than any other indicator out there, and I've just made it available to the public, so I think you'll find a lot of value in it as well. And if you do change your mind, just let us know, and we'll give you a 7-day money-back guarantee on that. No worries at all. Otherwise, that's all I've got for you today, guys. Thanks for tuning in. It's been another really interesting week in the markets. I know we've got another one coming up with a Fed decision. I'll be really interested to see. I think Jay will go 25 basis point unless something really bad happens over the weekend or Monday or Tuesday. But that will be the big one. All right, guys, I hope you have a great weekend, and we'll see you again on Monday afternoon. Take care.